Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. Welcome to this another Friday webinar. We have been doing webinars every Friday to educate ourselves in respect of new products that we have been seeing coming in the space of alternates, as well as the new developments that are happening in the market, be it micro or macro side of markets. In this particular webinar, we want to understand one of the new innovation in the product space that has been pioneered by Mr. Sandeep Tyagi, who brings with him 3 decades of experience. He is from IIT Delhi, has an MBA from Columbia University, and over his 3 decades of experience has only dealt with numbers and quant, and his vision of the company that he has set up by name Estee Advisors is ultimately that over a period of time, most of the assets will be managed by quant based strategies. Also, as investors, as advisors, we have been seeing over the last 5 years, alpha is something which has become very tough. There are hardly products which have been able to generate alpha. To generate alpha, fund managers have been trying more risky strategies, be it special situations or be it approaches like purely focusing on small caps, and hence beyond a point as assets increase, alpha again goes away because you can follow such high risk philosophies till maybe certain AUM. ST manages around 1,000 crores of assets and is claiming that yes, alpha cannot be kind of attained every year. But if quant is made to take investment decisions, it takes away the human biases and over a longer period of time is able to definitely capitalize on opportunities well. All these are tall claims, but ultimately, as an investor, we want to understand more from the founder himself, how much confident he is over next say 5 years if clients kind of show conviction and give him their hard-earned money in the hope of alpha. So, warm welcome to you, Sandeep, for this webinar. We have been doing, as I said, such webinars every Friday with fund managers like you to ultimately kind of build our conviction and select right products for our clients. And at the same time, obviously, this is not just a sales discussion. This is kind of a educative discussion. So we want to learn from your learnings which pertain not just to kind of quant but also in the context of your viewpoint and perspective on markets and economy. So we will do all that discussion over this 1 hour of conversation. I am kind of handing over to you at the moment. So your presentation that you have prepared for this webinar has already been uploaded, and I'm just going to start that. You may kind of begin with your opening remarks, and then I'll start with the presentation, and then you can kind of begin with that.
Okay. Well, thank you very much, Kamal. This is very helpful. This team and your organization has built a pretty new way of looking at these products which have been coming up. So great to be here and talking to your audience. ST Advisors is about 15 years old company. We started with a simple mission of saying quant investments will grow in India. It is a way of investing, a slightly different way of investing that most people are familiar with, because most of the world understands celebrity portfolio managers who have become very famous, whether it is Warren Buffett or Rakesh Jhunjhunwala. But really what you're counting on is their specific knowledge of markets, of companies, or their ability to read the nuances of the economy to position their portfolio well. Quant does it completely differently. Quant works on two basic principles. Number one, mathematics is always true. So 2 + 2 is always 4. What does that mean? What it means is that in the world of trading, if you have an index, say Nifty, trading at a certain price, and the 50 components that make Nifty 50 are trading at a weighted price that's different than the price of index, that cannot be true. So you have mathematics where 2 + 2 is not 4, it's something else, and that's not possible. So a quant investor would say, buy the cheaper thing and sell the more expensive thing, and you have an arbitrage profit locked in. You can do that with cash future in some ways. You can do it with put call parity arbitrage. There are many ways in which just math being true is always possible, and sometimes in the markets, due to demand and supply, it is not true. Now, the second way in which quant works is whenever you are trying to find a pattern. If I said what comes after 1, 2, 3, 4, 5, 6, you will say 7. Now, that's a very simple pattern, but in the markets, there are some complicated patterns which do repeat, and you can find them by doing detailed analysis, which is what we focus on. And that's the second way in which quant works. So 2 ways, arbitrage and long-term pattern finding, is what quant is very good at. So that's what our firm focuses on. And we have 2 main products in PMS space which focus on these 2 aspects. And I'll cover both of them as we go through it. Now, am I able to move this, or you would? I guess I can do this here. Okay. You already covered a little bit of our background, so I won't spend time. You covered my background. I won't spend time. I would simply introduce 2 of my colleagues, Gaurav and Vivek Sharma. Gaurav is responsible for all our business development, and Vivek is based in India and also responsible for our long alpha and I alpha strategy, as well as whatever we do in India markets. So they are 2 of my colleagues on the call, but not obviously presenting. To do this quant work is very different than doing fundamental work. A fundamental analyst, a single person, can read Economic Times, Bloomberg, all the news, and come up with their own views. And frankly, a lot of the investors out there read capital markets news or read the Wall Street and form their opinion on what they want to invest in over a weekend. Quant does not work like that. You need a lot of capabilities that we have built up. For example, in technology, we have hundreds of computers with terabytes of data, and we process information both for a long period of time, over 15 years, as well as in very great detail. So information that we look at, particularly to get our execution right, is at a tick by tick level. We have to have a significant size of team because you need many capabilities. We have over 125 people from some of the best schools, and we have capabilities which span from building a strategy, which is statistical quantitative work, to technology, which is deep computer science work, and operations and legal and compliance. So your team has to be able to comprise of all of these skills. Data, as I mentioned, we collect tons of data from many different sources, including CMIE, Bloomberg, Reuters, Morningstar. Many different sources of information have to be put together to build quant models. And of course, you have to be licensed properly. Now, as I was mentioning, the product, which is mathematical in nature, our product is called iAlpha. This fund has been running since 2009. It has an unbroken record. It's never lost money, and touch wood for that, over this period from 2009 till now. So over this period, every month we are able to produce positive returns, and the market is completely uncorrelated to what we are doing here, because we are simply saying math always has to be true. If index is trading at this price and components at some other price, cannot be possible. So this is an product which is positioned as an alternative to risk-free investment or fixed income investment. Of course, there are some operational risks, but on the whole, it is able to produce very good returns over and above FD returns by taking arbitrage positions. Now, we also compare them to other arbitrage funds. And as you can see, in all periods, we consistently outperform very significantly. And our Sharp, which is a measure of return and risk, is over 2, which means we are taking generating more than 2 times the risk we are taking measured as standard deviation. There are many questions that people may have. Is this the right time to invest in equities? Should I focus on getting into long equities at this point? What creates an edge in investment? I'll try to address many of them here. We focus mostly of time in market, not timing the market. We have done lots and lots of modeling. While it is possible to find some allocation alpha, meaning deciding whether to go into the market right now or not, but over long periods of time, it's very difficult to know that there is actually any predictability. In April of 2020, when COVID hit, a lot of people felt that the peak is going to be a long time in coming, and the downgrade will take 6, 7, 12 months, because that's what has happened in most of the downturns in the past. However, the market roared back and you had 70% return within next 8 to 10 months. And people who were sitting on the sidelines missed out on that upswing. So we don't claim that we have a very good insight on when to time the market. And we suggest that for most purposes, you should create an asset allocation and stick with it. So we don't suggest anything to do with market timing. You can choose between I alpha, which is a more stable, consistent fixed income kind of product, or long alpha, which I'll talk about just in a second when you want market exposure. And the right mixture of them is the right way to invest for most investors. Okay, so we talked about this. Of course, I hope that this group already knows. Very difficult to predict what is going to happen in a day. Very volatile. And if on the other hand, you look at what is going to happen over a decade, those trends are much easier to predict, and they look much more stable, and in terms of their direction seem to be moving up. So we focus in our equity investment to achieve results that will work over a period of time. Okay, now the period of time, as I mentioned, creates a big impact. The chances that you're going to win in the market, just without any bias of how good you are, on average, if you work in the market, one day it's 54% chance it'll be a positive day. 1 month, 61% chance. 1 year, 75, and 5 years, 98. But even at 5 years, you can still lose money in equity markets. So understanding the importance of period in which you are evaluating your performance and how it changes and impacts your predictability is extremely important, and one of the biggest emotional hurdle for investors who are coming in to the markets and trying to figure out how to invest. Most people tend to go in, decide it's working or not working in 2-3 months, and change product, and that may not be the best way to invest, particularly in a volatile asset like stock market. Of course, fixed income is different. Now, let's talk about how we create edge when we are not doing arbitrage, but we are looking at long-term patterns. Here is a cartoon we like to use. We see people looking at the market in one particular angle. And this is the famous cartoon of the elephant and blind men. But how does it apply to stock market? The way it applies is some people feel that particular type of factor is very important. And I see a lot of funds out there or PMS solutions which are essentially focused on momentum investing. Now, if you look at, this is a chart of which factor worked well over last 15 years. And we have color coded it so you don't have to look at the words. The different factors, blue is value. Sometimes value has done very well. Deep yellow is momentum. Sometimes momentum has done very well, and sometimes it has not done well. And what you would find is it kind of tends to almost alternate. Either it is on the top like value, or it is at the bottom and has not worked at all. So if you're looking at the market through only the lens of momentum, You'll have great years, but you'll also have some very bad years, and the volatility of what your investment is will be very high. Some people focus on sectors. Consumer goods is great, rural India is spending more, or defense stocks are fantastic. Now, if you look at the sector performance, again, you see really a lot of rotation. Sometimes some sector is working well because that's what is happening in the macro economy. Sometimes another sector is working well. And it's very difficult to have a very simplistic view that this is a great sector that will continue to work year on year for you. Similarly, one more angle is focusing on small caps. Now, small caps do outperform large caps on most years, but not always. And particularly if you were a small cap investor, then you did not have a good year last year, because last year small caps had a negative return when Nifty 50 and large caps did quite well, or at least much better than small caps. So no matter which way you look at it, if you're looking at an elephant as a blind man and only looking at part of the market, it's unlikely that you're going to have very consistent and good returns. So what is it that we do? As a quant investor, our focus is to look at multiple factors. No single factor or sector or market cap index can do the job. And if you want to build a stable portfolio, what you need to do is to look at all of these factors together. So a good quant investor would look at over 100. At Estee, we track 130 plus factors which comprise many aspects of the market. For example, factors, sector, capitalization, momentum, technical indicators. And I'll tell you a little bit about the product for a second here. This is its historical performance in the period that it has been live. And this is its performance over the backtest period since 2009 when we went live. So our alpha was quite significant, and it has continued to be significant in this period that we have been live, producing somewhere between 5 to 15% alpha over index by taking a multi-factor approach. Now, that won't happen in every year, but over periods of time, we expect it to be able to perform well because it is weighting the contribution of various stocks in a different way than what the index is doing, which is weighting it on market capitalization. And that skew that we produce in investment produces additional returns. These are the types of factors, more like a flow diagram right now. We used many dynamic factors like the ones I mentioned: value, quality, low volatility, momentum. We look at what is participating in index. So clearly that has a big impact on market returns, as 15% of the money is simply tracking index. So when somebody enters into in an index like Nifty, it has an impact on their demand and the prices change. Institutional holding, we pay attention to what mutual funds are buying, what foreign investors are buying, and how that is changing from month to month. Sector and industry rotation, we also evaluate whole sector and position our portfolio to what we think is happening at that period in time. It's not a static view, but a dynamic view. And market microstructure, which are all technical indicators which you might be familiar with, like Bollinger Band or RSI or SMAs, EMAs into the market, all kinds of technical indicators. And taking many variants of that gives us a perspective of what to expect. We put all of that together into a multi-signal library and adjust it based on two things. One is, what is the factor regime we are in? So we understand that in any given time, certain factors do well, others don't. And we base that analysis to predict which factors to give more weight right now. And the second is macroeconomic situation. So we track 18 factors in the economy, everything from inflation to interest rates to commodity prices, energy prices, and understand, given where we are today in macroeconomic situation, what would be its impact on our factor returns. So putting these two things together, we create our portfolio. And that's a pretty well-researched, well-developed approach for a sophisticated quant investment portfolio. I already showed you the performance the last year for quant investment was a little tough. We did underperform in the last 12 months, but if you look at for the period that it has been live, it has an active return of 21% over the index, which is the number in green that's highlighted here. But last 12 months were not as well. And as we told you that the performance evaluation period for a strategy like this is probably about 3 years. That's what I had as in terms of prepared remarks to introduce the quant investing approach that we take and what we do with our products. But it'll be great to hear and address your questions that you have.
Sure, Sandeep. I think this was a very crisp and clear presentation. Let me stop this presentation and start asking questions. So while as a platform we deal with a variety of fund managers, you kind of rightly covered that in few of your slides where you mentioned value, growth, momentum, quality, and investors would have a portfolio mix comprising of all these strategies. Now, generally speaking, for an investor who already has a allocation towards something like growth, something like value, now adding quant to it would lead to kind of a diversification which is beyond a point not good. Maybe it will hurt overall portfolio. So how would you address such a question? Because as a matter of fact, any HNI or ultra HNI client will not idly think of adding first a quant strategy. He would be more, I would say, comfortable first adding a fund manager, who has kind of a reputation in terms of being a thought leader in that industry, being a fund manager, a well-known name. And then, over a period of time, if he has experienced that despite it being a very well-known name, alpha is not coming, he's paying high fees, and he'll be disappointed. And then at that stage, maybe, he will think of adding a quant strategy. This is the real, I would say, thought process of any investor. So I don't want to kind of moderate this discussion, theoretically. So I'm just trying to, hence moderate this practically. So if you put yourself in investor's shoe, how will you want to position yourself for that investor in this context?
Sure. So look, in the world of investment, when people are trying to evaluate how to allocate their money, the first thing that people realize is if they are just getting market return, if that is what their benchmark, they shouldn't be paying too much fees. There are now mutual funds in the country which are charging 6 basis points to get you quote unquote market return. So if you just wanted what Nifty is doing, sure, great. That's you shouldn't be paying a lot of money, certainly not paying PMS fees to achieve that. Then when people become a little bit more sophisticated beyond that and they start having opinion on which factor exposure they want, whether they want value exposure, momentum exposure. Again, Nifty has now sub-indices where they track value and momentum and quality. And you could simply, now there aren't too many products which are doing that right now. But again, it's not hard to replicate something as simple as that. And again, maybe you should not be paying 6 basis points. There is more work involved. Maybe you will be paying 0.5% to replicate something like that. We measure our performance and we want to make sure that most performance is coming from what is called selection. That means within the index, we are selecting the right stocks. Within value, we are selecting the right stocks. Within momentum, we are selecting the right stocks. So the aggregation for us and the evaluation for us is how much of your return, and if you have the tools from, say, Bloomberg or Axioma or any of the other quantitative methods, what they do is disaggregate how much of your return is coming just because it is index related, how much is it coming because it's factor related, and how much is it because you have some secret sauce that you've been able to find, which is in addition to these factors. That's the question you need to ask, and we'd be happy to share that information with anybody who's interested. For us, majority of our return comes from the selection, not from any of these well-known factors. Now, if you are building a portfolio, which is the question you asked, and you have added well-known managers, and that's what you want to do, I think you need to compare it over a period of time and say, what am I paying for, and what is my net return after paying for cost, and what can I do as an alternative? And you can go in one of two directions. You can either try to compare it and say, where can I produce more alpha net of whatever I'm paying, or where can I reduce my cost and simply get market returns and do that. So I think there is a spectrum. There are some very good investors, the track record of some of the long-term, I guess Warren Buffett being one of the most famous ones, is out there for everyone to see. Over 50 years, he's been able to produce double the returns of S&P 500. So yeah, of course, there are people who can do it based on their views and fundamental research. However, Quant also produces very good pattern recognition type of returns, and they can find whatever value is there. For example, 20 years ago, Quant Research in Pharma French Research, they got the Nobel Prize for that, identified the three factors, whether you have a small cap, you will outperform a similar company, which is a large cap. So these factors have been known. And I would urge you to look at 3 to 5 years of return, compare them to the benchmark, look at both the return and the risk that the investment product is taking, and then make your decision, and then diversify. So I think your question of saying how to think is to evaluate against benchmark over a long enough period of time, and both risk and return, not just return.
Sure, I think well said. So, let's understand your strategy further in terms of risk and return and oscillation between risk and return. And hence the foremost question, what is the kind of diversification that your portfolio management style in your long only portfolio follows?
Yeah, so we have a couple of different variants. We provide a variant for retail investor as an investment advisor. That product is called Gullak. There we have a more concentrated portfolio because people can invest a much smaller amount of money. So if they are investing 20, 30,000 rupees at a time, then you can't put it across 500 names. But in our long alpha product, we track the BSE 500 or NSE 500 index as our benchmark. So the universe we are working with is the top 500 companies in the country. And we have two different approaches that are broadly going in. We are evaluating each individual stock, and we are also evaluating what sector we need to be weighted more towards. When we combine these two things, there are obviously weights we are giving to individual stocks, and there are weights we are giving to some of the sectors that we think we are going to be attractive in. When you combine that, we can have position in as much as 20% of the our universe, so about 100 names. Sometimes it's 70, sometimes it's 130, but we can have significant number of names in our portfolio. Now, that's very different from what a lot of fundamental investors do, because that's their limitation. They cannot understand 170 companies in the detail, produce the cash flow models, produce DCF models, talk to 170 managers and CEOs and understand everything about their competitors in space. Their methodology requires them to take more concentrated bets. So they will focus on 10, 20 names, whereas we adjust to our benchmark. So we are trying to outperform 500 stocks weighted by capital. So all we are trying to do is adjust the weights of each of those. So we could even have 500 portfolio names, just change their weights from their market capitalization to something else. and a lot of people do that. Those products are called smart beta products. But we take position in about 20% of the universe.
Sure, Sandeep. So, out of your both products, one on the long only long alpha product and the other one that I alpha product. So particularly I alpha product looks to be very unique because long only alpha product, there are a lot of variety of products. So let's first focus on I alpha. And I'm really curious to understand when you mentioned that there has been no single month since its inception that fund has delivered negative returns. The underlying universe is comprised of equities, and I'm assuming that it's a portfolio which is kind of a arbitrage type portfolio management. But I'm keen to kind of understand more from you. What's the style, and how is it that there has never been a negative return in that portfolio? Because long-term returns of that portfolio are close to 10%, and last 1 year return is also 7%. So hence curious to know this.
Yes. So these are the month-by-month returns for the period since 2009, so almost 14 years now. The way it works, as I mentioned, we take a position when we find an arbitrage in the market. So, and the example could be as simple as I mentioned, cash future arbitrage or index arbitrage. So if Nifty is at whatever, 16,000 or some price, and the components are at a different price, let's say 15,890, there is a 10 rupee difference between what is there as the component price, which is called synthetic index, and what is there as index future. And there should not be. Mathematically, these should be exactly the same, but demand and supply of individual products is different, and index is being sold independent of what the individual securities are being bought and sold at. So this happens all the time. And we have built a very sophisticated computer system to not only do this computation in real time, but be able to execute it in a very, very rapid way. So I don't know if your audience is familiar, but maybe 15 years ago, people used to do this trade sitting on their terminals in a manual way. It used to be called a basket trade. They would buy a basket and put it on the terminal, on a Nodin terminal, and say this basket is what I'm buying against Nifty. Now all of that is fully automated. There is no way a manual trader can find those arbitrage opportunities and catch them, because we have machines which are doing that at a speed of 1 millisecond or less. Really few microseconds. So the arbitrage opportunities in the market get taken away, which is actually a service to the investor community, because now nobody has to pay more than an unfair price, whether they're buying the individual stocks or they're buying the index. They're always getting whatever is the correct price for that. So because when we trade, we already know this is a profitable trade. That's why it's called arbitrage. So we don't lose money. Now, there are lots of technical, operational, and complexities which you have to manage. For example, the futures now deliver into physical security. So if you don't have the security, you have to manage your positions appropriately, that you can manage that risk properly. Index changes every so often. When index changes, the components change, and your price variation can happen because the market ends with one index set of components and opens with another set of components. And if you're holding components and versus index, their prices will change. So there are lots of nuance on how you manage it well, which is why it's not easy to do. But if done well, this is what you achieve, that you have a mathematical certainty that you're going to make a profit.
Sure, Sandeep. I think this is quite insightful. So, I was in the meanwhile looking at the chat. I see a lot of investors showing interest. I would urge to all our viewers who have a serious interest to kind of know more about the offerings to kindly go in within the menu items, where they have been typing. I have just shared a link to book appointments with us. You can click at the offer part of this section, and you can easily book appointments with us, because we may not be able to cover all the particular questions of all our clients, but we are happy to answer your questions one-on-one post this webinar over weekend or over next week as per your convenience. Moving on to further deep diving both these strategies and moving on to the long alpha strategy. It seems, and there is a perception I see generally, and also, I was reading a chat that quant based strategies could show higher churn, and investors are generally kind of worried about churn because higher churn means higher taxation. So, can you please throw more light on this aspect?
Yes, we model at many different rebalancing frequencies. So we have built models which trade or rebalance their portfolio on a daily basis, weekly basis, monthly basis, annual basis. We know that shorter the duration, higher the alpha we can produce. So we obviously take into account transaction cost, take into account the higher taxation that you have to pay if you are trading more frequently. And even after paying for that, the net return to the investor would be higher if they were to rebalance their portfolio on a shorter duration. I understand that the common refrain and the wisdom that we hear about is buy and hold, and people have an image that they're just going to buy some stocks and put it in a coffee can and forget about it for next 15 years. We have done all those analysis. Actually, in one of the posts on LinkedIn, I had put out the data on what has been happening to the portfolio that was published in some of these books. You can produce, surprisingly, there are some good names which continue to produce very good returns, even if you hold them for 10, 15 years, and that's great. But you can produce better results overall if you are a little bit more active in the market. Again, this is not what I would recommend. If my mother said, where should I put my retirement money that she has, I would suggest to her, go ahead yourself and trade every week. But if somebody is going to a professional manager like what we are, then we can produce better returns by staying on top of it on a lower frequency than annual or more length, and the net returns are better. So it is higher churn. We churn about 20% of our portfolio every month. And we think that produces about 30-40% better returns, not percentage points, but in terms of, better performance than holding the portfolio for 1 year, which we also have as a model.
Sure. So once in a decade, we see, events like we saw in 2020, that pandemic kind of a situation, or we saw in 2008, where actually equity markets correct by more than 30-35%. And then markets again show very drastic trends of kind of V-shaped recovery or a similar little longer recovery. So during such periods, it is again perceived that quant-based strategies kind of underperform, because if one keeps belief and kind of one keeps conviction on, one generally sees that market recovers and it comes back with a bang, and those patient long-term investors who do not give up, or maybe who add more when markets were down and who are focused only on valuations, they actually make a lot of money. So how does quant react to it? And if in the past, as per your experience, quant kind of missed it or actually encashed better than a fund manager, maybe in the recent past, please kind of explain with examples.
Sure. Well, I think there are two questions in there. One is, whenever there are these major events, there is the emotional pressure to simply sell and get out of the market. And that time and time again has been proven to be not the effective strategy. And I think we talked about that as in time in market is more important than timing the market. So whatever your allocation, whether you're investing in an index, or you're investing in a quant strategy, or you're investing in a mutual fund, Trying to superimpose your own thoughts on when to buy, when to sell is not likely to produce good results for you. These events are not rare. If we believe that returns are normally distributed as a bell curve. They're not. If you look at the actual distribution, events like COVID and 2008 and some of these events should have happened, not even once in 14 billion years, which is the universe life. So you cannot assume that the 2-3% volatility that the stock market normally has is a reflective strategy, because it's a 10 standard deviation, 20 standard deviation event when these things happen. So they don't follow those kinds of risks, and we cannot then ascribe to the volatility that we can predict timing. And recovery periods are widely varying. I gave you COVID example, and I also gave you the example. I can give you the example which happened in 2000 when the markets tanked, and it took Nasdaq almost, I think 13-14 years to recover to its peak. Japan has still not recovered from its debacle in 1980. It's all out 40 years that it has still been climbing up. So you can get into very, very tough situations. But the thing about average return is, if you invest average securities, you will get average return. When you concentrate, then you start having risks. Now, I guess your question was, is quant better in certain periods than other periods? I think, again, it'll depend on what type of quant it is. Just like a fundamental investors, some fundamental investors will do well in one period, not well in the other period. Similarly, the methods you use for quant will do well for one period, not do well for the other. Our focus is to continue to focus on selection alpha, not on factor alpha. If we are not getting too much of our return from small cap versus large cap, we are not a small cap fund. If we are not getting too much of a return from a particular sector, then we are not a consumer focused fund, or a defense focused fund, or an energy fund, or a financial services fund. If you're not getting too much of our return by going after value or momentum, then we are not a single factor fund. We are getting our return from our ability to find selection. And frankly, as long as you hold your AUM constant, just because there has been a bad time, our models should adjust to say these factors are working, these factors are not working, and recover from there. Now, if you were deciding whether to stay invested or not, that I don't think is a good idea. You should make your asset allocation and stay invested. And of course, based on 3 to 5 years of performance of a manager, if you're taking equity risk, you should decide which managers to use to make that allocation to. But stay in the market, whoever you have trust in.
Sure. So, let us understand from you further, because I see, a lot of clients, a lot of investors asking questions like, how does subjective evaluation take place? Because these days, many fund managers, you spoke about one like Coffee Can, throwing a lot of light on the subjective aspect of investing, whereby they say that we invest in clean businesses, debt-free businesses, where there are no corporate governance issues. Though obviously future nobody can predict. But all these moated businesses are seen as consistent compounders, though obviously it misses valuations. But from the point of view of now quant investing, how does quant investing see all these qualitative aspects while creating a portfolio?
Yeah, well, some of these factors that you mentioned, like debt free, or they are measurable. They are very measurable in quantitative world. So we do have quality metrics like debt ratio, leverage being used, whether their working capital is increasing or reducing. What is the quality of earnings versus cash flows? Are they just showing book earnings but not producing actual operating cash flow? All of those factors are measurable, and we do have it in our universe. Then there are subjective factors like quality of management. Is this CEO going to be a high-performing CEO or not? Yeah, that is not directly possible in quant world, but we do have social metrics. So we track information like analyst ratings, we track information like even uh, social sentiment that can be measured on what is happening on online in forums that people are doing. Again, we would not rely on a single individual's view, much less my view of what I think of the management. That's not our approach. When we will put it into the model, we will take as much information as possible. So we look at 100 analysts and say, what are they saying about this company? We may look at millions of people who are chatting about a company on social media and aggregate that information to say, what is the social sentiment about it? That's how we use that information. The difference is, are you using subjective judgment of one portfolio manager, or are you trying to aggregate intelligence of the crowd and put all of that information together for all the companies and do a relative evaluation? That's the difference.
Sure. Thank you so much, Sandeep. This was again, quite insightful. Again, subsequent thought that comes to my mind with regards to understanding your product further. It has been seen over times that investors actually happily pay fee to those fund managers who cut losses early and who kind of hold on to gains for long. And that's how portfolio managers, good portfolio managers have endeavored sincerely to generate alpha. Now, obviously, your portfolio does good churning, so I'm assuming it would be very good in terms of cutting losses. But higher churning would also mean that it may miss on many potential long-term gains. And actually, cutting down losses is something which is okay, but investors are more focused on generating wealth over longer term. And whereby, when we know that over last say 10 years, stocks like Bajaj Finance have delivered 45% CAGR return, how would quant react to a growing stock, which has underlying business, which again is showing good and bad quarters? It could be that in a bad quarter, a good business, which has I would say, a runway for further 7 8 years, gets taken out because of quant throwing wrong, I would say, decisions, wrong results. So what's your answer to this?
Absolutely. No, I think that's a very good question. The way quant would address that is, we would evaluate, for example, the question that you put out there, Bajaj Finance or, Asian Paints or HDFC Bank or whichever big compounder you look at. And you say, okay, well, how many times has it happened that a company has performed very well for 7 years and they continue to perform for next three? That's a factor. What is the performance over any period of time? You can take 7 years, 3 years, 5 years, take your pick. That's a factor. Now, everybody remembers the 5 or 7 companies that have compounded very well. But, if there were 20 companies and which had done very well for last 5 years and you invested in them, would they all have performed? Because I don't have a way of saying this company is better than this company. Only thing I can evaluate for you and for our portfolio is, when, as you said, a company has performed well for 7 years, do they continue to perform well in the 8th year? What is the likelihood of that? And I compare it with all the other 130 ways in which I look at the stocks, and then I score them. So I say, yeah, they've got a good track record, so that is some likelihood they'll continue. Great, let's put that factor in. But it is one of the 130 factors that we have looked at. And again, the proof of the value is, are you able to generate good returns over and above what index investing can do? And way to compare any method with any other method is to say, over a period of time, what returns are you able to produce? Do you really care about how many times did we buy or sell? Do you care about how many times we held on to something? Yeah, it is easier to understand if I said, here are the 3 magic names that you need to buy and just hold it for 10 years and you'll be rich. It's a very easy story to understand, and people love easy stories to understand. But our mindset is somewhat different. Our mindset is the price action kind of overlays the fundamental value of the company all the time. Companies, Nvidia is now $1 trillion company. Is it a good stock to buy or a bad stock to buy? With every company, you can have that question. At certain price, it's a great business to buy. At certain higher price, may not be so.
Sure, I'm reading out, question from the chat box. Once the
Mhm.
quant models are crystallized, is there any human intervention at any stage of investing?
No. There is human intervention in refining the factors when we are researching, but there is no human intervention once the model is in production. So what it does on a day-to-day basis, on a month-to-month basis, is completely automated. It runs the process. Of course, we look at the results. We ask questions. For example, our model has been consistently underweighting financial services, and financial services have been doing well. So we would look at something like that and say, what is going on? What are we missing? And we would go back and relook at financial services fundamental factors, go in depth, try to understand what is going on. We may come back with, yeah, it is just an anomaly, and over a period of time, we don't think that this will bear out. But we would investigate. That is subjective. Of course, development of factors, development of how to weight things, how to identify new trends, that's subjective. That's where our research team comes in. But execution of the model on a periodic basis has zero subjectivity. We don't second guess the model we have built.
Sure, how often do you revisit to refine your model?
While we are always doing research, there is a significant size of team that is constantly looking at markets. We also operate in several markets. So we have models for other emerging markets like Brazil and China and in even US. And every now and then we will find something in the process of research that makes some things better. There are no new sources of information that keep coming in. As I mentioned, social sentiment is something that is growing in the last few years. So we keep bringing that in. It's a continuous process. There is no specific time frame. The models are dynamic. That means they adjust to the markets themselves. So just because the market is changing, we are going from a bull market to a bear market, or we are getting a lot of inflows from foreign investors versus not, or the economy is up or down, inflation is up or down, that doesn't require us to rebuild the models. But new sources of information, new insights on how we should create factors that we can keep adding on.
Does quant, investing and the model and the algorithm also take into account the current, cycle we are in terms of macro environment?
Yes, as I mentioned in my presentation, let me see if I can bring it up. This is our method. So when we put all these 130 micro strategies together, we get a multi-signal library. And the way we combine or give weight to them is dependent on two different regime estimators. One regime estimator is what factors, which of these strategies has worked well, and what do we think is going to continue to work well. That's one. The second is, what is the macroeconomic situation right now? As I mentioned, we track 18 different macroeconomic indicators, everything from inflation, interest rates, energy price, gold price, you name it. And based on that, we say which factors we would want to put in there. So the combination of the two things give us a view of which factors we are going to combine and give more weight to. That's what generates our portfolio.
Sure, Sandeep. So moving
I
on to
see some
the,
other questions here. Is
yeah,
100 to 130 companies over diversification? As I mentioned, we are trying to compete with the index. The index for us is BSE 500 or NSE 500. That has 500 stocks in it. So we could, and the stocks have a particular weightage assigned to them now, which is their market cap. If we took all 500 and gave them slightly different weights than what market cap is, that's also still active investment. Whatever is the difference between market cap weight and the weight we have given to the stock is our active component of investment. So this concept that you are an active investor only if you have 10 names, I don't think is necessary in quant investing. Active investment is any time you are giving weight that is different than the index weight in the market cap.
Sure. Moving
So,
on.
yeah.
Yeah. You want to say something?
No, I was just reading some of these questions. So that was one from Karthik Sharma. There was another one from Abhishek Saraf saying, I alpha designed to beat the benchmark index or deliver certain fixed level of returns. I alpha is meant to deliver returns over FD rates. That's what it is supposed to do. It is uncorrelated to the Nifty returns. Actually, it has zero components of where Nifty is in its build up. So it should not be compared to index. You know, we would not feel great if we generated positive returns when the index was down. Because it's not meant to be competing with that, and we won't feel bad if the index did 30% return and we still did only 10%, uncorrelated. So go
Sure,
ahead.
Sandeep. We'll move on to the last part of this webinar. Let's try and understand, what Quant says about some of the other aspects, which is like you mentioned, for example, a viewpoint on coffee can portfolio. So what is the Quant, saying, or your algorithm saying? Because a lot of investors have a lot of money which is lying in stocks like Bajaj Finance, Asian Paints, HDFC Bank, and likewise, which are assumed to be consistent compounders, moated businesses. And it will be interesting to know, perspective that you have or the Quant has over say next 3 5 years.
Yeah. So as I mentioned, by the way, I will put this up. These are my and Estee's web properties. People can follow us on Twitter or on LinkedIn. And I posted an analysis that we had done on specifically Coffee Can book. I think it came out in, I think 2017 or 18 or something like that. And it had a portfolio of I think about a 15 names or something like that. We went back and we tracked it, and what we found was that the names did outperform index. So that is kudos to the methodology that was created. That they were able to pick names that over a period of 5 years were able to do as well and better than what index did. But it did not outperform an active management portfolio that was rebalancing every month. So, I mean, there are investors for sure, like um, Warren Buffett's track record is there for everyone to see. He's been investing for 50 plus years. I mean, what is it now, 65 or some years, and he has produced double the returns of the index. So yes, you can buy, hold, and do very well. That's a different skill set than what we bring to the table. What we bring to the table is active management of what is happening right now relative to the market across 500 names on a consistent basis. And that approach produces good returns in our experience, and we measure these things consistently. And we believe that for our skill set, that's what we can do. Now, if the thing with these analysis is there is only the time only goes in one direction. We cannot go back in 1965 and invest in Berkshire Hathaway. The question you have to ask is, would Berkshire Hathaway or anybody else that you think is a great fundamental investor continue to perform that way for next 50 years? I don't know the answer to that question. So I can only factor in that as one of the factors now and say, okay, if a fund has performed well for 3 years, what's the likelihood that they'll continue to perform next year? That's the question to ask.
Sure, Sandeep. I think This is quite, modest of you to kind of say it like that. Finally, move on to the last part of this webinar. What's the view that quant-based fund manager has to give on markets in the current context of valuations, macro environment?
Yeah. I will have to duck that question. I do not provide any guidance. As I said, we do not monitor that or have any ability to predict whether it's a great time to invest or not. All I can tell you is me personally, my company, and our advice to our investors is to stay invested. We have our own capital invested in the markets. We haven't run away. We haven't also increased it disproportionately. So we build a diversified portfolio according to the factors and stay invested. We do think that the markets are, from a valuation perspective, somewhere in between. The PE is whatever, 17, 18, 19, somewhere in that range, which is not overheated. It was 23, 24 just a year ago. And it's not too high, too low either. It was 15, maybe 3 years ago or 4 years ago. So it's somewhere in between. The macroeconomic situation for India looks pretty good. We are one major economy that's still producing growth. I think the last published was 7.2%. That's fantastic growth rate for the quarter. And we think we will continue to do well in India. So optimistic about what equity investment can do. I think it is the only consistent way of generating income and wealth. There's very simple analysis that we do. If you think that an average investor would invest for 40 years, when they invest is maybe 25 years and they'll continue to invest and save till they're 65 before they retire. 3% difference between fixed income and what you can generate in stock market. Let's say 8% is what you can generate in fixed income and 11 is what you can generate in stock market, will result in 3 times the money in their pocket over the period of 30 years and even more over a period of 40 years. So doing systematic investment, proper asset allocation is the way to build wealth over long periods of time. And we try to do it in our way using a diversified, historically true portfolio.
Sure, Sandeep. You kind of made me think two more questions. If you allow me, for say subsequent 5 minutes, I'll ask two more questions.
Sure.
You mentioned about your own money also invested in some of these strategies. So could you please throw more light on your skin in the game? Are you invested also in quant type portfolio management of yours?
Absolutely. Yeah, absolutely. Very significant part of my personal net worth is invested in this, directly or indirectly, of course, in the company and through the company and otherwise.
Sure. And lastly, you also mentioned about comparing fixed income and equities, and 3% differential over 40 years kind of obviously is a very big difference. Where does real estate stand in between? Because we as human beings need to build a real estate asset also. So if one has to kind of think of building a house, should that be done at cost of reducing equity portfolio, or that's also not a good idea?
I think it depends on what are you comparing it to, and also depends whether you are buying real estate for living or for investment purposes. Real estate is a fixed asset that is more comparable to fixed income investment than equity investment. Real estate over long periods of time and over average of all real estate investment would perform closer to fixed income than it'll perform closer to equity investment. Of course, it varies by location, your luck, and specific time period you're talking about. But if I look at long history and I average real estate investment, that's what's true. The second thing to understand is, of course, everybody, and particularly some people, are very emotionally attached to living in their own home. And that's very understandable. It's a safe way to live. and save some money. It is not likely to go down to zero for sure, and probably not even a lot. So it's a safe way to invest. It's like a indirect way of buy and holding, so it kind of keeps value. And if that emotional part is kept aside and you're looking at an investment, let's say your second home, if you were to buy an apartment or put that money and give it on rent, or put that money in equity investment. In India, in all likelihood, you will do much better if you put that money in the index funds than if you were to put it in a second real estate apartment, even after paying for taxes and the advantages that government gives. And the simple reason for that is the rental yield in this country is only about 2, 3, 4%. It's not a lot. So the capital appreciation, the cap rate of real estate in this country is very high. People love investing in real estate, and they bid up the prices much more than what the rent they can charge on it. And because they're counting on capital appreciation, they're counting that even though I'm making 2, 3% return on my interest on my rent, the property will appreciate 10%, so my return will be 13%. But that doesn't really happen. I think there are periods where 20% appreciation happens, and then there are periods where nothing happens for 2, 3, 4, 5 years. And if looked in aggregate, I would say in aggregate, real estate right now is probably not a very good investment from savings perspective, because it is concentrated. You can only buy 1 or 2 apartments, and what happens to that building, to that location, will have a big impact on your returns. If that becomes the best destination over the next 10 years, you'll make a lot of money. If there is a highway that comes right next to it and it's a very crowded location, you may not make a lot of money. And we can't really predict these things on what will happen where. So a diversification is a problem, and it's very illiquid. If you need the money, you can't really convert it into cash in any kind of a hurry. Now, REITs are coming into the country, and that would be a good part of allocation, particularly in your asset allocation against fixed income. That would be a good way to diversify some of that investment over long periods of time. Especially now that the taxation for fixed income is very disadvantageous, I think long-term investment through a diversified portfolio would be a good option.
Right, Sandeep. I think it has been really insightful, conversing with you. The overall webinar kind of has been quite thoughtful, and the perspective given by you with regards to quant style of portfolio management has really given a food for thought. I myself never used to believe that a quant-based portfolio can generate alpha, but I do see both of your portfolios delivering alpha in longer term as well as delivering consistent returns, especially during tough times when markets have been down, portfolios have fallen lesser. So this is really interesting, and some of the logics that you have given, why and how this happens, also sounds quite convincing. We have to understand more about the fee structure, but I kind of leave that for maybe further discussion. We have already spent more than 1 hour, and I urge all investors who are serious to know more should book an appointment with us. I already see while I was conversing with you, there are a couple of appointments that we have already kind of getting through this webinar. But I would urge investors who seriously want to kind of know more about such I would say innovative portfolio management services. We are kind of one of the industry's well-known platform. We have deep dived many portfolio management services through lens of quality, risk, and consistency. And hence, we have very deep insights. The kind of perspective that we can share with our clients, our investors, is very different from anybody else. Thank you everyone for coming today for this webinar. We'll see you again subsequent Friday. Have a nice weekend. Thank you.
Thank you very much, and happy to answer any questions that were not answered. If you want to ask me on any of my online presence, I do respond to questions from investors all the time, so happy to do that.
Okay, thanks. Bye.